Similarly, if you think of the insurance business, then insurance, like banking, also plays an immense role in the overall development of an economy. As you know, insurance is nothing but a mechanism which provides a protection to all the members of the society against the risk to which they are being exposed to. And the risk can happen at any point of time. And because we know that the future is uncertain, we need to prepare ourselves against those, against the happening of those risks to occur in the future. So in insurance, what happens? The companies which are into the insurance business, they provide us with some security, with some protection against the risk to which you are being exposed to. And whatever money is being generated by the insurance company, that money again in turn is going to be used for the development of the country. So that is the reason why we need to know about some basic aspects of banking and some basic aspects of insurance, which is there in your syllabus. To start with, we'll today discuss about, in a nutshell, some aspects of your module 1, which basically covers the basic aspects of banking as well as some basic aspects of insurance. So because, as I had already told to you, we have very limited number of classes. So in today's class, I will go to explain before you some aspects of banking, and the next class we will discuss about some aspects of insurance. Now, to start with the module 1, the basic part in this module is basically related to the banking system in India. So before going to know about the banking system, we first of all have to know what bank is all about, what role actually the bank plays. Now, as you know, bank is basically a financial institution which accepts money or accepts deposits of money to be used for the purpose of lending and investment. And bank is a financial institution which deals with money and credit. It generally mobilizes the surplus money in the economy in the form of deposits and use it in the form of providing loans and advances. Generally, if you look at the working of the banks, particularly, you can find out that the banks normally play the role of a financial intermediary. By financial intermediary, I mean to act as an intermediary institution between the savers community and the investors community. It is the savers community which are having the surplus money with them, and it is the investors community which are in requirement of funds. And the presence of both the communities is essential for the successful working of an economy. The second role that the banks play is basically the role of a constituent of the payment system. We know that every economy is having a financial system. Without the presence of the financial system, no economy can run. And financial system basically performs with the help of the payment system. Payment system generally helps in facilitating the transactions that takes place in an economy, and accordingly in settling the transactions that takes place in an economy. So whatever transactions takes place in an economy, unless and until they get settled, no financial movement can take place in the economy. That is the reason why bank, as a constituent of the payment system, helps in settling the transactions that takes place in the economy. The third role that the banks play is basically the role of a financial services provider. So apart from acceptance of deposits and lending of money in the form of loans and advances, the banks also provides some other sorts of financial services which are required by its customers. They help us in keeping our valuables with them by providing us with locker facilities. They help us in maintaining our demat accounts. If we want to invest in the securities market, then with the help of banks, we can do that also. They help in providing us some other financial products which are not of their own. through the distribution services. So from a bank, you can get the insurance products, you can get the mutual fund products, you can get the securities of the companies. Okay. And with the help of banks, we can also make the payments of our utility bills. Apart from that, banks also help us in managing our wealth. So they also act as a wealth manager. My intention of saying all these things is that from all these points, we can infer a common conclusion that banks are considered to be pivotal for the overall economic development of a country. Now, coming back to the banking system, particularly related to our country, when we are thinking of the banking system, in India, we generally have a two-tier system. But the matter of the fact is that whatever banking system we have, at the apex of all the banking institutions, there is a bank which acts as the controller as well as the supervisor of all the banking activities. And in India, we have the Reserve Bank of India with us, which act as the central bank of our country. So in the banking system itself, the central bank is at the apex of the banking institutions. And it is the central bank of a country which generally goes on to supervise or monitor or regulate all the banking activities that takes place in the economy. So apart from RBI, whatever system we have in our country regarding the banking system, we have a two-tier system, as I said to you. In one part, we have a commercial banking system, and in another part, we have a cooperative banking system. I'm now going to share you with some slides through which it will be easier on your part to find out what the banking system in India is all about. So kindly tell the host to make me the co-host so that I can share. Sagar Mahanti, who is host, please make me the co-host. Otherwise, I cannot share before you, all of you. Is it audible, Sagar Mahanti? If you are there, please make me the host.
Yes, sir, I did.
Okay, thank you. Thank you. Let me share. Is it visible to all of you?
Yes, sir.
Yes, sir.
So I've written here the banking system in India. Now just enlarge this slide. Here I have written the organized banks in India, and at the top of it, I have written RBI. So RBI, as I said to you, is the central bank of the country, and it is at the apex of the banking institution. If you observe the banking system of each and every country all over the world, you can find in each country, there is a central bank of that country, whereby the central bank generally acts as the banker to the government. And it is the responsibility of the central bank to regulate, to monitor, as well as to supervise the banking activities that takes place in the economy. So below RBI, it is written that there are two different types of banks, commercial bank and cooperative bank. So under commercial bank, we can either have scheduled banks as well as non-scheduled banks. Scheduled commercial banks and non-scheduled commercial banks. Under scheduled commercial banks, we have the public sector commercial banks, the private sector commercial banks, the foreign banks, and the regional rural banks, RRBs, or generally we call those RRBs as the Gramya banks. And non-scheduled banks are normally known as the local area banks. They basically are being confined to local areas. So the scheduled and non-scheduled, both the categories come under the category of commercial banking system. Apart from commercial banking system, we have another banking system which generally is prevalent in the rural areas as well as in the semi-urban areas, which is known as your cooperative banking system. The cooperative banking system is such that we have a three-tier cooperative banking system, one at the village level, one at the district level, and one at the state level. But the more visibility of the cooperative banks you can see in the district level in the form of urban cooperative banks, as well as in the state level in the form of state cooperative banks. Now coming to what scheduled bank is all about, what non-scheduled bank is all about. Now, as I said to you, RBI is considered to be the principal regulator, principal supervisor, principal monitor of all the banking activities in a country. Therefore, RBI has certain rules and regulations which all the banking companies need to follow. And RBI is basically running through a separate act, which we call as the RBI Act. So in the RBI Act, there is a schedule, which we call as the second schedule of the RBI Act. And all those banking companies which are included in the second schedule of the RBI, all of them are being called as the scheduled banks. So for being included in the second schedule of RBI, there are certain criteria which are needed to be fulfilled. If any bank fulfills those criteria, then automatically that bank becomes a scheduled bank. And the criteria is such that the banking institution or the bank itself must be carrying on a business of banking in India. So it must be involved only in the business of banking, not in any other business, and must have a paid-up capital and reserve of an aggregate value of not less than 100 crores. Earlier, it was 5 lakh rupees when the RBI Act was being enacted in 1934. But as the time passed by, the capital requirement got increased. Now it is 100 crores, or you can say that from 2016 onwards, it has been also enhanced to 500 crores. So minimum paid up capital of 500 crore is a must criteria for any banking institution to be considered as a scheduled bank. And third, it must satisfy the RBI not in a manner detrimental to the interest of the depositor. So it should not be involved in any sorts of activities whereby the interests of the depositors are being affected adversely. If these three conditions are being satisfied in any bank, then automatically that bank becomes a scheduled bank. So whichever bank becomes a scheduled bank, they automatically get the membership of the clearinghouse and they can deal with checks. So here you can say that non-scheduled banks cannot deal with checks, but scheduled banks can deal with checks. So whichever bank you come across, if you find that the banks are dealing with checks, they can issue checks, they can collect checks, then that bank is considered to be a scheduled bank. And 99% of the banks operating as commercial banks in India now or in present day time period are considered to be scheduled banks. Non-scheduled banks, as I said to you, basically they are being called as the local area banks. Their business is being confined to a particular locality. They act as commercial banks. They can accept deposits, they can lend money and advance money, but they cannot deal with checks. Because they are not being a member of the clearinghouse, because they have not yet qualified on the criteria of capital requirement, which is 500 crore nowadays. Therefore, they are being considered as non-scheduled banks and their business is being confined to a particular locality. If you look at the cooperative banks, then in the at the village level, we have the primary agricultural cooperative credit societies, which are basically being present in the village areas. In each village, you can have a primary agricultural credit cooperative society. And in a district, whatever are the number of villages, and in those number of villages, whatever are the number of primary agricultural credit cooperative societies, together they form the district cooperative bank, district central cooperative bank. So without the presence of the primary agricultural credit cooperative society, district credit cooperative bank cannot be established, because all the primary agricultural credit cooperative societies automatically becomes the member of the district cooperative bank as they contribute towards the establishment of the district central cooperative bank. Similarly, all the district central credit cooperative bank, they together constitute or form another entity at the state level, which is known as your state cooperative bank. If you look at Odisha, we have Odisha State Cooperative Bank, which is a scheduled bank nowadays. And Odisha State Cooperative Bank is having the members in the form of all the district central credit cooperative banks. Then we have some idea about the banking system, and we found that in the banking system we have the commercial banking system and the cooperative banking system, and most of the transactions that takes place in the economy are basically being routed through the commercial banking system. One thing you also need to remember here, that the cooperative banks, although are being regulated by RBI, but to a certain extent they are also being administered by the respective state cooperative societies act. So in the activities of the corporate, all the activities of the cooperative banks might not be looked after by RBI. There are some activities which are basically being carried out by the cooperative banks on the basis of the terms and conditions or rules and regulations which are being enshrined in the respective state cooperative society act. But all the activities of the commercial banks are definitely being observed, monitored, and supervised by the RBI. Now, coming to the other aspect, which is there in the syllabus, it is related to the principles of banking. And whenever we are talking about the principles of banking, it is basically related to the principles of lending by banks. And here by banks, we generally mean the commercial banks. As I said to you, as a bank, or the role of a bank is such that it mobilizes the surplus money from the savers community in the form of deposits and tries to channelize those funds for some productive ventures. That means it gives those funds in the form of loans and advances to those investors community who are in requirement of funds, so that by taking that fund from the banks, they can go on to use it for some productive purposes. Thereby they can be able to create some employment opportunities, which in turn will lead to generate some more income. If income gets generated, then automatically there will be more demand for the product. If more demand for the product will be there, then automatically there will be more production to take place in the economy, and accordingly the economy can grow, can develop. So here, when we are supposed to know about the basic principles of banking, it is generally related to the principles of lending by banks. Because the bank is considered to be a financial institution which specifically deals with public money, that's why it is the prerogative of the banks that it must have to take care of this public money. It should not go on to utilize the public money as it desires to. Because as we have gone through the scheduled bank rules and regulations, we found that the banks should not be involved in any sorts of activities whereby it will be considered as detrimental to the interest of the depositors. So because of the fact that the banks are dealing with public money, it is imperative on the part of the banks that the banks must have to use those money, which they basically use in the form of provision of loans and advances, in such a manner that they should ensure the safety as well as the security of those public money. That is the reason why certain principles have been laid down by the RBI, which all the banking institutions must have to follow at the time when they are going to use the funds which they have mobilized from the savers community. Now, if you look at the principles of banking, there are certain principles which all the banks need to abide by. And the first such principle is the principle of safety. As I said to you, since the banks are dealing with public money, it is the responsibility of the banks that they need to ensure the safety of that public fund. Because if that fund gets lost, then automatically it will be loss of the community or loss of the savers or loss of the depositors as a whole. So in that process, the interest of the depositors will be affected adversely. So whenever the banks is supposed to use the funds, either in the form of provision of loans and advances or in the form of investment. It should ensure that to whomsoever, either organization or individual, it provides the loan is supposed to be repaid within the time period for which it is being taken. Similarly, if the banks are supposed to invest the money into some ventures, then the bank must have to ensure that those ventures will ultimately repay or will ultimately generate that much of money along with some return on it within the time period for which it has been invested. Then only they can ensure the safety of the funds. So this is the reason why RBI has come out with certain investment norms where the banks are supposed to invest. So banks cannot invest on their own. Whenever they go for investing the funds after giving the loans and advances, whatever surplus money they have with them, when they go on to invest that money, they need to invest it as per the prescriptions given to them by the RBI. They cannot invest arbitrarily, they cannot invest on their own. They definitely have to invest as per the prescriptions given by the RBI. In that process, they can ensure the safety of the funds. So as an individual, if you think of, it is your hard-earned money when you go on to invest somewhere, what aspect you are, first of all, you are thinking about? You are thinking about the safety of the funds. Suppose you are supposed to invest 10 lakh rupees in some ventures. So before taking a decision to invest 10 lakh rupees of yours, which is considered to be your hard-earned money, you are thinking many a times before entering into that venture. Because the first and foremost thing that strikes in your mind, is the money safe or not? Is the investment I am going to make it safe or not? Similar thing happens with the bank. Because the bank is dealing with public money, they need to ensure the safety of the funds. The second principle is considered to be the principle of liquidity. By liquidity, we mean the ability to pay for the payment obligations as and when it is required. Ability to pay for the payment obligations as and when it is required. As we all know that banks are dealing with public money. So it is obvious that the public must have to get back their money as and when they require it. And bank is not aware at what time period all the depositors will come and ask for their money. So bank must have to be ready enough at all the times to pay the required money as desired by the depositors. So in that process, the banks have to maintain liquidity. The banks have to be in a position always so that they can be able to pay back the money which is required by their depositors. So liquidity means the bank must have to be ready enough with sufficient money with them at all times so that they can meet the needs and requirements of their depositors. That is the reason why they cannot go on to use all the money that they mobilize from the savers community. That is the reason why they need to keep some portion of that mobilized funds with them, either in cash form or in liquid form. Liquid form means the form which can easily be converted into cash as and when required. So generally you can find that if you look at the operation of the commercial banks, you can find that they have some money with, they basically keep some money with them in the form of SLR. We call it as the statutory liquidity ratio to meet the needs and requirements of their depositors. And also they use, they keep some portion of the mobilized fund in the form of some liquid assets. Liquid assets means assets which can easily be convertible into cash. So as and when they require, they can easily convert it into cash. That is the reason why they need to maintain the liquidity of funds. The third principle is the principle of diversification. Diversification basically reduces the risk factor. As we know, every investment is attached with some risk. And the banks, which generally provides the loans and advances, it is considered to be one form of investment by them. Apart from loans and advances, whatever money they go on to invest in whichever ventures, that is also considered to be an investment. And since banks are being involved in investment activities, they are supposed to be exposed to some risk. So we know that if we put all our excess in one armory, then there will be difficulty that we are going to face with. That means you cannot keep all your money in one basket. You need to keep the entire money in different baskets, so that if any basket doesn't provide you the adequate return that you are expecting for, the other basket can give that, and accordingly you can make up with the loss that you have suffered from the first basket. So diversification basically helps the banks in managing the risks to which they are being exposed to as an investor or as a financial institution when they are being involved in providing loans and advances as well as in investment activities. So the principle of diversification is also required to be abided by all the banks as prescribed by the RBI. The fourth principle is the principle of stability. Principle of stability means the banks, since are dealing with public money, they need to ensure their stability in the long run. So no bank can run away from its core activities or from its core functions. Because it is dealing with public money, it must have to ensure its stability over the long period of time. Because people have faith on the banks, because people have trust
What are the
on the
questions
banks,
will be
so the
asked?
trust and faith of the
Hello.
what?
So what are the
Hello.
questions will be asked on the examination, sir?
That I will discuss now. First of all, we
Okay,
need
okay.
to be clear about the subject. We need to be clear about the
Okay, sir.
concepts. Then only we
Yes,
can
sir.
think of questions. Na? From the
Okay, sir.
very
Okay.
first class, how can we discuss about the questions?
Yes, yes.
Once we are clear about the concepts,
Yes, sir.
then I can say you these by using this concept, these questions can be framed or such type of questions can come in your examination.
Okay, sir.
So we are
Thank
not
you.
reading it from the examination point of view. I just want to
Yes, sir.
appraise you about the basic concepts of banks. Might
you.
be some of you are well known about these facts, but many of you might not be.
Yes.
So it is our responsibility as a teacher that we need to appraise you about the basic concepts first, because once the conceptual clarity is there, then you can think of discussing about the questions.
Yes,
Otherwise,
sir, yes.
there will be no meaning to the questions. That is the reason why initially I said, since we have very limited period of time, within 10 classes, such a huge paper cannot be
sir.
covered in totality or in entirety. So we just need to go through the basic concepts only. After that, we'll discuss about the questions. Clear?
Thank you.
Or if you require any sorts of hand notes on it or any sorts of notes on it, I will also provide it to you through ma'am. So that
Oh.
module wise, I will prepare the notes and I will send it to the ma'am.
Yes, sir.
Ma'am
Yes.
will share it with you.
Yes. Okay,
Yeah.
sir. Thank you, sir.
Thank you.
Thank you.
So stability means the banking institutions must have to ensure their own stability because they are dealing with public fund, because they have the trust and faith of their customers with them. So they need to maintain their trust and faith. Then next is your profitability. As you know, even if the banks are acting as financial institutions, by nature, they are considered to be commercial. And any commercial organization, if you think of, it is not without the objective of maximization of profit. As a banking institution, when you can attract more customers or when more customers will be attracted to you, if they find that your bank is running on a profit over the period of time, then they can pose their faith as well as pose their trust on you. So for ensuring the stability of the organization, profitability is a must. You need to attain profitability. You need to use the funds in such a manner whereby you can be able to generate some profit. So without being a profitable organization, you cannot run over the long period of time, or you cannot ensure the stability of an organization. As we have already discussed about the principle of stability, so the principle of profitability is attached to that. Without profitability, stability cannot be ensured. So profitability indicates, or principle of profitability indicates that whatever activities the banks are being involved in, at the end, being a commercial institution, they must ensure the profitability of the organization. They must ensure that they are being able to generate that much of profit which they are expecting for from all such of activities in which they are being involved with. Apart from all these principles, nowadays another principle is also being avoided by the banks, which we generally call as the principle of service quality as well as the principle of secrecy. Because the banking institutions are operating within a very competitive environment, and as we have pointed out in the banking system, that there is the existence of private sector banks, there is the existence of foreign banks, there is the existence of public sector banks. So all these banks are basically operating within a very competitive environment. And because banking institutions belong to the services sector, they need to come out with better service quality to their customers. So whichever bank will provide the better service quality, that bank will ultimately attract more and more customers to it. Therefore, you can find that in the last 25-30 years, the nature of public sector banks has changed. With the arrival of the new private sector banks, with the arrival of foreign banks in the early 2000s, you can find the activities or the quality of service of the public sector banks like SBI, like PNB, like Can Bank. So all the quality of service being given by these commercial banks, these public sector banks, actually have improved a lot. It is because they find tough competition from their private counterparts as well as from their foreign counterparts. So service quality they need to maintain, because today people don't have that much of time with them. And if you go to the bank and if you feel that you are being ill-treated by the bank staffs, the next day you can think of taking away your money, closing your account with that bank, because you are not satisfied with the service quality. So it is a must for all the banking institutions in today's modern day banking that they must have to ensure provision of better service quality. Another thing which I told to you is basically the principle of secrecy. Principle of secrecy means, as banking institutions, since the banks are aware about all sorts of financial transactions of their customers, so it is needed on the part of the bank that they should not go on to disclose the financial transaction of their customers to anybody. They need to maintain that much of secrecy. Unless and until they are being asked for it by any government institutions or by the court of law, they cannot go on to disclose the financial transactions of their customers to anybody else other than their customers, or without the instruction of their customers. So that is known as a principle of secrecy. These are the basic principles: principle of safety, principle of liquidity, principle of diversification, principle of stability, principle of profitability, principle of service quality, principle of secrecy. Now coming to the Banking Regulation Act, it is also there in the first unit. As I said to you, banks are acting as the financial institutions which deal with public money. So it is a public institution. And every public institution is supposed to follow certain rules and regulations. And all the banking institutions which are operating in our country, India, all the banking institutions basically follow the rules and regulations which are there enshrined in the Banking Regulation Act. As I said to you, RBI Act is also there, which was being enacted in the year 1934, by virtue of which the RBI basically works. And in the RBI Act, earlier there were some provisions related to the activities of the banks, or how the banks can pursue their operation, those who are being given in the RBI Act. But with the invention of this Banking Regulation Act, a wide range of rules and regulations has come out regarding the operation of banks in India. So if you look at the legislation of banking in India, it is the basic legislation. It is the primary legislation, the Banking Regulation Act 1949, which is of utmost importance to understand how the banking companies operate in India. Now, in the Banking Regulation Act, the first and foremost thing is the definition of banking. So, which type of companies can act as banking companies? What type of services? What type of activities they must have to be? They must have to carry out. Those things are being clear through this definition of banking. So in the definition of banking, as I said to you, the primary role of every bank must have to be the acceptance of deposits and lending of money and investments. Apart from that, with the passage of time, many sorts of services have been included on a timely basis or in due course of time. And in the modern day, the definition of banking has changed. But thing is that whenever we are talking about the definition of banking, as you know, banking is a very wide term. Banking is considered to be a very broad term. So we cannot have a concrete definition of banking. You cannot generalize the definition of banking. Depending upon the rules and regulations through which all the banking companies are being abided by, we can have different definition of banking for different countries. So whatever banking means in our country, India, that doesn't mean the same in USA or in Australia or in any other country. So as per our rules and regulations, the primary role of all the banks must have to be the acceptance of deposits and lending of money. This is being reflected in this definition. The business of banking company and the prohibited business. Permitted business, main functions, usual banking activities, subsidiary functions or services. Under the subsidiary functions and services, many sorts of services have been included, which are not earlier there in the original Banking Regulation Act. So some amendments has been made to the Banking Regulation Act, and those amendments are being reflected through the subsidiary functions and services. So day by day, in due course of time, the subsidiary functions and services have actually been increased for the banking institutions. Prohibited business means they are being debarred from doing all such activities. As I said to you, they must not be involved in any such activity which is detrimental to the interest of the depositors. That is the reason why the BR Act, Banking Regulation Act, has come out with certain activities to which the banking institutions are not allowed to enter. So if you look at the prohibited business, so they should not be involved in trading activities by acquiring a control in non-banking companies, or they should not hold shares in other companies beyond a certain limit, or the holding of shares in any company in the management of which any managerial personnel of the bank is interested. These are the prohibited businesses. Then capital requirement, as we have already pointed out, that originally it was 5 lakh rupees, then it was being increased to, in due course of time, it was being increased. And for many years, since 99, 2000 up to 2014-15, the requirement becomes 100 crores. Now the requirement has increased to 500 crores. And for commercial banks to operate in India, this is the capital requirement, 500 crores. By commercial bank, I mean the private sector banks as well as the foreign bank. But for foreign banks, there are some limitations apart from it, whereby we can say that capital has to be increased above rules must be complied within a maximum period of 2 years. If the paid up capital is less or is more, then it has to be complied with the rules. So minimum paid up capital 500 crore as of now. So
What is-
regarding what?
Sir, what is the current requirement for the paid-up capital maximum as per rule?
500 crores for banking companies, particularly for commercial banks, particularly the domestic banks. And for foreign banks, actually, it has been increased to 1,000 crores. If any foreign bank is interested to operate in India now, since 2016, the limit has been increased for foreign banks. Since 2014, the limit has been increased for domestic banks. So if you are a domestic company, you want to enter into the banking business in India, then you must have to show that your paid-up capital is 500 crores.
For
And
foreign
if you are
bank,
a
it is
foreign
1,000 crore.
for foreign companies, 1,000 crore. For foreign companies which are interested in doing banking business in India, the minimum capital requirement is 1,000 crore. Apart from that, some other requirements are there. Initially, they need to open 2-3 branches. Then within a specified period of 2-3 years, they need to expand their branches up to a certain limit, like that. But the capital, if you look at the capital requirement is 1,000 crore for foreign banks, 500 crores for domestic banks.
Thank you,
Clear?
sir. Thank you.
Okay, thank you. So this is related to the share capital and reserve fund, what they need to maintain. So you can take the screenshot of this also, so that it will be easier, because we cannot go to the details of it. Then related to the board of directors, related to the management of the banking companies, the provision is such that at least 51% of board of directors of a banking company must consist of persons who have specialized knowledge and should not be proprietors of any trading, commercial or industrial concerns. So you cannot include proprietors of any trading concern or of any commercial concern into your board of directors. As you know, board of directors is basically considered to be the highest decision-making authority, and the board basically calls for the annual general meeting, AGM. In the AGM, all the shareholders need to be a part. But thing is that the board is being presided over by the chairman. So every company has its own chairman, or you can say that CMD, chairman cum managing director. In many companies, you can have chairman as a separate chair, and managing director is having a separate chair. But in some companies, you can also find that same person acting as the chairman cum managing director. So in the board of directors, whatever might be the number of directors, minimum 51% of the number of directors should have the expertise in banking. A whole-time chairman not to be adjudicated insolvent. So whoever will be appointed as the chairman of the company, whole-time chairman, he should not be, or she should not be an insolvent person as declared by the court of law. So these are the basic things which are required. These are the parameters on the basis of which the chairman gets selected. Because ultimately the chairman will be selected. In case of public sector banks, the chairman gets selected by the finance ministries. In case of private sector banks, chairman gets selected through their board of directors. Then maintenance of liquid assets, you take the screenshot of it also. So minimum 3% of total time and demand liabilities in the form of CRR, which can increase up to 15%. So time and demand liabilities means time deposit and savings and current account deposit. Demand liabilities include savings and current account deposits. Time liabilities include the term fixed deposits as well as the recurring deposits. So whatever money is being mobilized, minimum 3%. Now the CRR limit in India, you can find it is basically hovering around 4.5 to 5%. That means if you mobilize 100 rupees, so minimum 5 rupees you have to keep in the form of CRR, which can be increased to 15%. And CRR is basically that portion of the total deposits which all the banks are mandated to keep with the RBI. So as individuals, when we are opening our bank accounts with the bank, in the similar fashion, all the banks basically open their account with the RBI. They maintain their account with the RBI. So that constitutes the CRR. Not to hold shares in other companies more than 30% of the paid-up capital of the company, or 30% of its own paid-up capital, whichever is less. So whatever is your paid-up capital, up to maximum 30%, you can hold in the form of shares in other companies. So these are the different parameters which are given related to the maintenance of liquid assets. Then licensing of banks. So unless and until the bank gets a license from the RBI, the bank cannot operate its business in India. And for licensing, as you know, for Indian banks, there are some criteria which they need to fulfill. Affairs of the company are not being conducted to the detriment of the interest. So these are the conditions. But the thing is that they need to get the license from the bank and from the RBI. And RBI basically provides the license for a period of 3 years. Every 3 years, the license is supposed to be renewed, both in case of foreign banks as well as in case of domestic banks. Depending upon the operation of the banks, depending upon the performance of the banks, the RBI can go on to renew the license of the banks. Then opening of new branches, for that also you need the prior approval of the RBI. Earlier, branch-wise approval was required. Now the situation has changed. Yeah, as a banking institution, you just have to provide the information how many number of branches in a year you are supposed to open, and for those number of branches, at a stretch, at a time, you can get the approval from the RBI. And the powers of RBI as being enshrined in the Banking Regulation Act. As you know, RBI is the regulator of the banking activities. So these are the powers of RBI, and RBI basically uses these powers. They have the power to issue license. They have the power to inspect the activities of the banks. They have the power to issue directions. They have the power to control the management of the companies, like that. So these are the different powers of RBI as enshrined in the Banking Regulation Act. So this is all about the basic things which is there in your first module. The other portions of the first module we'll discuss in the next class. Some banking aspects will be there and some insurance aspects will be there. Because there are 5 modules, so I am thinking of covering each module in 2 classes, so that in 10 classes we can cover in a nutshell major portions of all those things which are there in your syllabus. But don't worry about the notes. I will provide you with the notes, and we'll also discuss about some of the questions when the class gets over. Clear? Are you all clear?
Yes, sir.
Thank you
Yes,
all.
sir.
We'll meet day after tomorrow at the same time. Thank you. Thank you very much.
Thank you, sir.
Anybody wanted to know about the diversification after the class gets over? Somebody has texted. Subhash Mishra. Subhash Mishra, are you there?